Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Analysis and Technical Readout, May 28, 2026. This video presents a direct informational narration of the source document.
All right, looking at today's data, we're seeing a market really being driven by some intense sector divergence, heavy options mechanics, and of course, some underlying geopolitical tension. So let's just dive right in and break down the institutional structural data for today. Here is our roadmap for this explainer. First, we'll examine market performance and sectors. Second, geopolitics and index concentration. Third, we'll detail the April PCE inflation data. Fourth, key equity technical updates. Fifth, megacap and volatile tech. And finally, number 6, the ISRG strategy and software.
Okay, let's jump straight into Section 1, Market Performance and Sectors.
So all four major indices actually moved collectively higher today. They managed to maintain those elevated levels pretty well, right? After just a brief 20-minute deviation right at the open. This momentum was absolutely driven by semiconductors and the Megacap 7. Now, out of the 11 S&P sectors, healthcare really led the advance, while utilities kind of lagged behind. And interestingly enough, this was one of those rare trading sessions where typically opposed equities, like your heavily weighted tech, semiconductors, and software, literally all rallied simultaneously.
Moving right along to Section 2, Geopolitics and Index Concentration.
The geopolitical landscape out there remains highly volatile. To give you the facts, the U.S. struck an Iranian military target in Abbas twice within a 3-day window, which then prompted a responsive strike by the IRGC on a U.S. airbase. At the exact same time, there were rumors circulating of an unfinalized 60-day memorandum of understanding that would require U.S. presidential approval. Now, those reports were later flat-out denied by Iran's Tasnim news agency. But despite all this conflicting news, markets are essentially pricing in an open Strait of Hormuz. With Brent crude nearing that $90 threshold, any drop below 90 is going to ease supply concerns as alternative global refined products step in to supplement the market.
Now, thinking about index concentration, the statistics behind the S&P 500's recent performance are honestly striking. Get this. During the 2-month period spanning March to May, the index rallied 19%. But exactly 10 specific stocks drove 69% of that entire rally. If you expand that to the top 20 stocks, they account for over 80% of the movement. That leaves the vast majority of the remaining equities effectively stagnating. It's a real top-heavy dynamic.
So how is the index so resilient? Well, it's largely explained by some severe sector divergence. Right now, technology and semiconductors have very low sensitivity to oil prices and broader inflation metrics. They're insulated. Conversely, sectors heavily exposed to raw economic inputs, we're talking airlines, cruise lines, and travel booking, they are bearing the absolute brunt of these inflationary pressures. And as a result, they just continue to lag significantly.
Let's transition into our macroeconomic data readout in Section 3, April PCE inflation data.
Let's dig into the exact numbers for April. Core PCE month-over-month came in at a positive 0.2%, which is just slightly below the 0.3% estimate. Core year-over-year reached 3.3%. That matches estimates, but it does mark a rise from the prior 3.2%, making it the highest level we've seen since November 2023. As for the broader headline PCE, month-over-month was 0.4%, coming in just below estimates. And headline year-over-year hit 3.8%, which perfectly matched estimates and stepped up from the prior 3.5%.
Next up is Section 4, Key Equity Technical Updates.
Let's kick things off with Eli Lilly, ticker LLY. The equity found really solid support near that 900 level, sitting within an extreme downside limit range of 871 to 928. It successfully broke through its final major resistance at 1090, actually opened the session at 1096, and hit an all-time high. But a quick note of caution here, the primary risk to this valuation right now is any downward revision in growth rates. If that happens, it would force an aggressive PE contraction.
Drilling down into those forward valuation parameters for LLY. For 2026, the estimates are sitting at a low of 1066, a midpoint of 1267, and a high of 1448. When we project out into 2027, those estimates naturally step up to a low of 1251, a midpoint of 1460, and a high of 1668.
Moving on to Microsoft. The equity exhibited a massive heavy volume breakout, which is a classic pre-catalyst move ahead of its upcoming AI developer conference.
The immediate upward target is a 15% expansion, landing in that 498 to 516 range. To get there, though, it has to chew through some minor resistance between 440 and 461, and then medium resistance from 469 to 490. Keep in mind, and this is a structural constraint, its historical PE ratio typically fluctuates between 25.3 and 31.5. As for Amazon and AMD, volume stayed pretty low today, with their immediate trends unchanged. Tesla, on the other hand, is trading within incredibly tight parameters. You want to monitor strictly for either an upward break past 465 or a downward failure below 419. For AMD, medium upside resistance sits at 442 to 453, and if it clears that, there's a significant vacuum all the way up to 560. Downside support is layered, first at 400 to 420, with a much harder floor down at 334 to 360.
Now, you might be wondering what's fueling some of these moves? Well, a lot of this current price action is being driven by options market squeeze dynamics. What happens is heavy call option buying creates a big imbalance. This literally forces market makers to aggressively buy the underlying stock just to remain delta neutral. But be warned, this mechanical buying pressure can violently reverse. If short-term capital flows out, those same market makers will be forced to short the stock to hedge put options, which aggressively accelerates the downward velocity.
Let's shift gears and look at Section 5, Megacap and Volatile Tech.
Looking at NVIDIA, pullback parameters map out support starting below 211 and extending all the way down to 175. Because of NVIDIA's sheer market capitalization, expecting daily 10% jumps is just unrealistic, unless we see a massive sector rotation to supply the necessary liquidity. Elsewhere, Alphabet is holding really strong ahead of a potential SpaceX IPO catalyst, while Apple is currently locked in this slow, grinding upward option squeeze.
Snowflake represents a textbook extreme volatility case right now. Despite an absolutely massive 36% jump post-earnings, the equity is fundamentally overvalued. Its intrinsic value is calculated below $200, even if you assign it an aggressive 60x forward PE multiple. Hard downside support is mapped precisely at 217 to 235. To the upside, resistance levels are staggered at 238, 252, 262, 279, and finally a broader zone between 292 and 309.
And finally, Section 6, ISRG Strategy and Software. The technical setup for ISRG reveals a massive 2-year top formation that's been building since 2024. Because of this, it requires a strict, incredibly patient institutional accumulation strategy. There is an exceptionally wide 80-point entry zone spanning from 321 to 405, intended for a planned 7% total allocation. The key here, you absolutely must wait for a confirmed bottoming formation within this wide range. Do not aggressively front-run the trade before the downward trend fully exhausts itself.
Wrapping things up, the IGV Software Index is currently tracking steadily toward a target of 100, albeit on low volume. The critical test lies just above this level, with a documented resistance zone sitting between 101 and 107. Now, if the IGV can actually push past this 101 to 107 resistance zone on high volume, it signals a definitive market leadership shift, which leaves us with the ultimate question: are we about to see the software sector officially dethrone semiconductors and take over as the primary driver of the broader market? We'll find out soon enough.